Well, do you think rate hikes are going to push us into a recession?
Well, so the only thing that rate hikes can really control here, because all the inflation we're seeing is two main things. One is there's all the fiscal stimulus, so it's more money in the system. And number two, you have supply side inflation, so commodity shortages, supply chain problems, add a war to the mix. And so the Fed, they can't print oil, they can't print copper, they can't fix supply chains. So all that they can really do is try to reduce demand, which risks putting you into a recession. Right? It's kind of that whole game of they want to slow down demand, maybe soften it, get a dip, but they don't want to cause a recession. But it's almost like you're kind of stuck between a rock and a hard place here. So I'm not optimistic that they're going to have a soft landing, as they like to call it.
I saw Janet Yellen make a presentation in Montreal a couple of years back, and she said that recessions are caused by two things: fiscal imbalances and the Fed. So that was my question, whether or not the Fed is going to cause the next recession. So let's talk about what the Fed is doing right now. Let's go back to what you mentioned earlier about rate hikes. I've heard economists argue that what they're doing anyway isn't going to be enough to fight inflation. We've got inflation at 7.9 was the last reading. It's CPI is coming out soon, so who knows what the next month's going to be. What is a level that's enough to fight inflation? Keep in mind, in the early 80s, we had double-digit inflation, and the Fed funds rate was also at double digits. So do we need to see interest rates at the same level of inflation, percentage-wise, before we see inflation come down? Is that what we need?
So that could certainly give a shock to the system, a deflationary shock. But I think the inflationary pressures are deeper than that. I don't think the Fed's tools really, especially given how high debt levels are, that they really have the tools to properly fight inflation. I think it's more of a fiscal problem, and it's more of just how we've structured supply chains. I think that this is only going to be resolved by improving supply chains, improving commodity capex, kind of the real world changes, and those are not quick changes. But one thing I caution people on is that for example, I'm staying in the inflationary camp. Before the war, I was expecting maybe like a localized top in inflation. So we've obviously added fuel to that fire. But I don't really expect inflation necessarily to be a straight line.
Yeah.
I think that we're going to be in a very inflationary decade compared to the prior decade at least. But even I'm still anticipating eventually slowdowns in inflation. Maybe the Fed gets a handle it for a period of time, but then they end up having to loosen because they go too far, you have a recession, and then they cut, and then you get another round of inflation.
That's right.
So in the 70s, you saw multiple rounds of inflation. In the 40s, you saw multiple rounds of inflation. These things tend to come in bursts.
That's interesting. You said that it's a fiscal issue, not so much a monetary issue in itself. I'm wondering if that's could be resolved by the government, Congress, rather than the Fed. Because suppose the Fed were to reduce the growth of M2 money supply. Are you saying that wouldn't be sufficient? You also need congressional support to somehow rein back spending, I guess?
Partially, because it depends on where that M2 growth is coming from. So, for example, in the 70s, it mostly came from bank lending.
Yeah.
Right? Banks would lend more money into existence because you had the demographics boom, right? So you had all the baby boomers starting to buy homes. Because of the demographic demand for commodities, and you had the whole the M2 expansion from loans, that was a contributor. If you go back to the 40s,
yes,
it wasn't that banks were lending; it was that the government was spending a lot of fiscal deficits, into existence and having it monetized.
Right.
And so that's the M2 growth we've seen over the past 2 years. A lot of it is from that fiscal impulse, and they're rather rate insensitive. I mean, if they want to pass a fiscal bill, they're not looking and saying, well, what are our treasury rates at? They're just kind of passing it, right? So it really comes down to watching political gridlock, right? Because that's the environment that they're increasingly in, is this kind of gridlocked environment. And so it really does come down to Congress, but even if I think you had a perfect Congress, bringing this down immediately without causing, kind of a recession is challenging. It's kind of pick one, inflation or recession, and only in the longer run can you say, okay, how can we have the economy allocate its resources better? How can we get more commodities? How can we get more infrastructure? How can we diversify our supply chains? And that only comes with time. I
want to touch on debt and interest rates. You study the history of debt in the United States. Correct me if I'm wrong, Lyn, but according to your research, I believe you stated that in World War II was the last time we saw huge amounts of national debt. How does our current debt level compare on a percentage of GDP basis compared to that of World War II?
Yeah, it's comparable to the peak in World War II. It's the only other time we were this high. Obviously, there are some foreign countries now that are higher, such as Japan and Italy, countries like that. But the United States is kind of touching the top that it was at in the 40s. And that's also the environment where when they had super high inflation, which was caused by fiscal spending related to the war, they still held interest rates low.
It's interesting because we don't have a world war right now, right?
We don't know, but we have, for example, supply chain issues. You have kind of the same sort of effect on the war. I was actually asked a question on the podcast once, like, if you didn't know COVID happened, and you're looking at the current economic indicators and stuff, what do you think's happening? I would say it looks like a war.
It looks like question. I think I'm going to steal that.
It looks like it looks like wartime finance.
That's right.
And that's something that, because when debt levels are that high and you have rising populism and you have rising, all sorts of issues like that, recessions become crises, right? What should be a normal recession instead gets this gigantic response, right? Because they're so levered they can't afford a recession. And that's when you get those more inflationary, fiscal heavy, wartime finance looking things. And then we went and added an actual war to the mix now, right? So even though the United States is not at war with Russia, there's all these proxy wars happening now. There's financial wars happening. There's supply chain wars. There's commodity wars. And of course, there's the actual kinetic war. So I would say now we've actually entered the fray of really being at war.
Wow. Back then in World War II, in the 40s, what was the interest rate level?
Well, the interest rate, they kept the short end of the curve at almost zero, something like, I think 0.3%. And then they capped the long end of the curve at 2.5%.
Right.
So you had an artificial positive shallow yield curve.
Okay.
But inflation would go up to 19%, then come back down to negative 3%, then go up to 12%.
Yeah.
And just kind of bounce around. It averaged like 6% for the decade, even though interest rates averaged 0 to 2.5% because they held the whole yield curve below the inflation rate, which is actually what we're starting to see in Japan. They're starting to do formal yield curve control. And then you see Europe and the Fed, they're not doing formal yield curve control, but they're purposely behind the curve of inflation. They're letting kind of some of this debt inflate away, and then they're slowly now kind of waking up to raising rates.
I would imagine, maybe not officially, but I would imagine the Treasury might be having conversations with the Fed and telling them to, slow down on raising interest rates, because at current debt levels it becomes rather unaffordable to have interest rates at a historical 3, 4, 5%, wouldn't it?
Well, that's the rock and the hard place, because on one hand, one of the worst things for re-election is high inflation and low consumer sentiment.
That's right.
Which is what the Biden administration is facing, which is what Congress is facing. So on one hand, you want them to control inflation, but it's like you can't always have what you want. If you have this high of a debt level, and if you have these structural problems with your supply chains and your commodities and your economy, and so you're kind of stuck between a rock and a hard place. And I think the Minsky moment comes when the Fed eventually breaks something with their tightening, and yet inflation's still here.
Right.